You have $1,000 right now. Maybe it is sitting in your bank account. Maybe you just got paid. Maybe you saved it over 3 months. Someone, a friend, a coworker, a headline, just told you to put it somewhere smart, but where? Stocks are at record highs and economists are whispering the word recession. Cash is losing value every single month to inflation. And gold just crashed 23%. But the biggest banks on Wall Street are still calling for $6,000 an ounce by December. So what do you actually do with $1,000 right now? I'm going to give you the most honest answer you will hear anywhere. Not a sales pitch, not a sponsored opinion. The real answer backed by data, and by the end of this video you will know exactly where that $1,000 belongs and why. Stay with me because the answer I land on in the second half is the one most financial channels are too afraid to say out loud. If you are new here, hit subscribe right now. Every week on this channel, I break down exactly where smart money is moving and what it means for people like you. One click. Costs you nothing. Do it now and let's start with cash. Because most people watching this are keeping that $1,000 in a bank account earning maybe 4% interest. That sounds okay until you do the math. Inflation in 2025 averaged 3.8%. In the first quarter of 2026, it printed at 3.4%. Your 4% savings account is giving you a real return of less than 1%. After tax, you are losing purchasing power. Quietly. Every single month. Here is the harder truth. The US government has printed money at a scale most people cannot process. 80% of every dollar in existence today was created after 2020. The national debt just crossed $39 trillion. There is a $1.5 trillion gap between what the government collects and what it spends every single year. What does that mean for your $1,000 sitting in a savings account? It means the thing you are holding is slowly being diluted. Not dramatically, not overnight, but the direction is one way only. Cash is not a safe option. Cash is a slow loss dressed up as safety. So we cross cash off the list. Now stocks. The S&P 500 has had an incredible run. And the standard advice from every financial influencer in 2023, 2024, even early 2025 was simple. Just buy an index fund and hold. And for a long time, that worked. But here is where it gets complicated. The March jobs report just came in at 65,000 jobs added. That sounds okay until you remember February printed negative 92,000. 2 consecutive months of weakness. The Federal Reserve cut its 2026 rate projections. Recession risk is not gone, it is quietly rising. When recession hits, and historically after a cycle this long it always does, stocks do not drift down slowly. They drop fast. In 2008, the S&P lost 57% in 17 months. In 2020, it lost 34% in 33 days. If your $1,000 goes into the stock market at the wrong time, it can become $600 before you even check your phone. I am not saying avoid stocks forever. Long term, a diversified index fund is still one of the most powerful tools a regular person has. But right now, in April 2026, putting every dollar you have into stocks is not a calculated bet. It is hope dressed up as strategy. So stocks get a partial score, not zero, but not the full answer either. Which brings us to the one option nobody in your friend group is talking about. 3 months ago, gold was at $5,595 an ounce, the highest price in human history. Then it crashed 23% in 60 days, and every comment section on every finance channel declared the gold bull market dead. Here's what actually happened. The Federal Reserve surprised markets. Speculative traders who had borrowed money to bet on gold got forced out by their brokers, what is called a margin call liquidation. But it was not a fundamental collapse. It was mechanical selling by leveraged investors, and it ended the moment the last forced seller was done. Goldman Sachs, the most respected investment bank on this planet, looked at that crash and kept their year-end gold target at $5,400. They did not lower it by $1. JP Morgan is at $6,300. Wells Fargo is at $6,100 to $6,300. UBS, Bank of America. Every major institution on Wall Street kept their targets unchanged or raised them through a 23% crash. That does not happen when a market is broken. It happens when institutions see exactly the entry point they were waiting for. Now here's the part that matters for your $1,000. You do not need to buy a full ounce of gold. You can buy fractional gold, 1/10 of an ounce, 1/4 ounce. You can buy a gold ETF like GLD. You can start with $100 of exposure and scale from there. The point is not to go all in. The point is to have a position before the move, not after. Because historically, in the 4 months after the first Federal Reserve rate cut, gold rises an average of 6%. The Fed is signaling a pivot by the second or third quarter of 2026. That window is open. Drop a comment below right now and tell me, where is your $1,000 sitting today? Bank account, stocks, crypto, gold, whatever it is, just type it below. I read every single comment and I will personally reply to as many as I can. So here's the answer I promised you at the start, the honest one. If you have $1,000 right now, I would not put it all in one place. I would split it, and here's exactly how I would think about it. $500 into a diversified index fund, not individual stocks, an index. You get market exposure, long-term compounding, and liquidity. If recession comes, it hurts, but you hold and it recovers. It always has. $300 into gold exposure, not jewelry, not a coin you bury in the garden. A gold ETF or a fractional physical position. You now have an inflation hedge, a recession hedge, and a dollar debasement hedge. All in one asset that central banks from China to India are actively buying right now. $200 stays liquid. Emergency fund. Opportunity fund. The world moves fast, and having cash ready to deploy is a position. That is not a perfect formula. There is no perfect formula. But it is a real, grounded answer for a real person sitting on $1,000 in April 2026. Not a pitch, not a product, not an affiliate link. The single biggest financial mistake people make is waiting. Waiting for the perfect time. Waiting until they have more money. Waiting until it feels safe. It never feels safe. The people who built wealth did not wait for safe. They made a decision with the information they had, and they stayed consistent. If this video gave you one thing you did not have before, one clearer way to think about your money, then it did its job. Next week, I am going deeper on gold specifically. I am covering what happens when the Fed makes its next move, and what that single decision does to the price trajectory towards $6,000. That video will matter. And you will want to see it before the move, not after. Which means you need to be subscribed before Wednesday. Subscribe right now if you are not already. Hit the bell icon too, so you get notified the moment that video drops. And if this video was worth your time, a like takes 1 second, and it tells YouTube to show this to more people who need it. Subscribe, like, and I will see you Wednesday.